I think perhaps the biggest catalyst for a slowdown in the housing market is going to be mortgage market review. A mortgage market review, really importantly, is stress testing people's ability to service their mortgage. And so they are looking at what happens if interest rates would rise by 3%. Would that mortgage still be affordable to the potential borrower at that point? And what that's likely to do is to preclude some people from being able to move, but it will mean for those who are able to, it will put a cap on the amount of borrowing which they are able to take out. And we've seen that occur in some other ways. So we've seen the Bank of England limit the amount of borrowing at in excess of 4.5 times salary as well. Those two things combined will act as a slowdown. I think it also means that the slowdown will be greatest in London because you have more borrowing at higher loan to income ratios than you do across the rest of the country. The fact that mortgage market review has already came in April, beginning to stress test people's affordability, already showing signs of cooling certain parts of the market, do reduce the risks of a bubble forming within the UK housing market. I think an early interest rate rise would compound that and certainly would pull back some of the rates of house price growth that we've seen in some of the hotter parts of the market more generally. But even so, the idea that rates will rise has seeped into the public consciousness because of the level of speculation which you have about when those rates will rise in the media. And I think you will therefore see some parts of the market cool over the period of the next 6 to 12 months. In other markets may gather a bit of pace, those where there's more capacity for house price growth, where the ripple effect of positive sentiment is beginning to feed into those markets. So you will see a shift in pattern of where the house price growth is occurring.